All right, all right. What's up, y'all? What's up, y'all? And welcome back to the channel. We back here again today. We want to do a quick reaction to the FOMC meeting from today, the July 2023 FOMC meeting. I'm Mike. I'm back here again with Marcus, and this is Dual Economics. Before we get started, Marcus, go ahead and let them know.
This is not financial advice. We are not financial advisors, but we're gonna let y'all know what's up with this FOMC meeting today. Though this is some important stuff we need to review. So
Correct. So
we getting into the video.
Yeah, we're gonna go ahead and get into the video. Like Marcus just said, we're not financial advisors. We're just doing a reaction, giving our opinions, and hopefully giving y'all some information. So with that being said, let's jump straight into it. All right, let me find the video.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a quarter percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments.
All right, bro. He just said that they're tightening, and all of the pain of their tightening has yet to have been felt. Did you have anything that you want to say on that?
I mean, Jerome waiting for some pain, man. Unfortunately,
that's what I'm hearing too, bro.
Unfortunately, man.
That's
Y'all got to understand. Yeah, man. Y'all got to understand that, man. Y'all got to understand that, man. Like, in order for all this to be right, he got to mess some stuff up. I ain't what I want to say. He trying to switch up.
He's been saying it consistently though, bro.
Like a robot.
Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be.
He also just said that mortgage rates are down compared to a year ago,
weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers.
You want to say something, bro?
Yeah, people need to lose their jobs in order for, unfortunately, we letting y'all know what's up, but people need to lose their jobs. The economy needs to feel pain.
Yeah, bro.
Before we can get back right. You know what I'm saying? So, like I said, this is the perfect time. Like I said, this is the perfect time.
I agree.
Not to be buying real estate now, not to be buying no house now. We ain't buying no houses now, but your stocks, your cryptos, Bitcoin, any altcoins you want to buy, like this is the best time to be buying it right now, because there's gonna be fireworks in the next 2 to 8 years, so you better load up on whatever it is you want to buy right now.
Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, a 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite all of it,
you heard it. He said we got a long way to go.
We got a long way to go, y'all. Like I said,
longer-term inflation.
My projection 2025. That's what I think. 2025.
Expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We're also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate.
Ho! I did not catch that at first. The first time I heard this, you heard what he just said?
Go back. What he said?
Let me take this back. Just a moment.
Holdings. With today's action, businesses and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We're also continuing the process of significantly reducing our securities holdings.
Right there.
With today's action.
You heard what he just said?
About their security holdings.
Yes, you know what I mean? He said we're reducing our securities holding.
So that mean they selling stuff off, ain't it?
They finna start selling stocks, bro.
Yeah, man.
That
so
mean that they finna start selling
bro,
stocks.
and like I said, man, like I said, like and why I'm buying so much crypto right now is because the stock market is full, bro. Like, man, do you see these prices? These prices.
They've been selling stocks over the last year. He just said they finna start selling off more securities, bro. Which
means that this could possibly be one of those. You think this could be a double bottom recession,
bro? Think about all the people that got a bunch of money sitting on the sideline that's worried. All the people who scared about the market.
They straight, bro. They said they straight.
Listen. If the interest rates are going up, and the government just told you they about to sell off securities, all they about to do is just take their money and park it in a CD or something like that. Because they're gonna avoid getting hit with the security sell-off. So there's almost no reason. I wouldn't say all stocks, but based on P ratios being high, stocks being at an all-time high, there's almost no reason to buy stocks, bro, coming for the next few months.
And if you are in the stock market, like this is the perfect time to be taking some profits. I'd be selling. I'd be selling. But this thing though, like stocks been going up, bro. Crypto has been sideways. Nothing.
I'm about to go ahead and hit but I think stocks really just been going up because everybody been expecting him to expecting the Fed to actually cut rates.
The stock, yeah.
So
who knows? We've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investments. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability.
He said we need below-trend growth. So we need some kind of contraction to go on in the labor market and the markets in general.
It is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Oh, that was actually a little bit shorter than I thought. Hold on one second. Let me see what we got here. All right, so before he get into his questions, did you have any specific questions, bro? Well, before the audience start having questions, you got anything you want to talk about?
Yeah. So my question is, what effect do these interest rate hikes have on real estate market? So if I'm in the market right now to buy a house, say I want to buy a house right now, would this be the right time to buy a house right now? Like if I was in the market, say if I don't have a big lump sum just put on a house. You know what I mean? Say I'm the average person. I want to. All right, hey, I'm ready. Oh man, I'm ready to buy a house. You know what I mean? I got me a little.
I think this right here is the case when it comes to that. If anybody is financing anything, whether it's a house, a car, a sofa, if anybody is
a sofa,
if anybody is financing anything right now, I feel like it's a bad time. Number one, prices are high right now. Number two, the interest rates are high right now.
And they still going up, and interest rates still going up as we speak.
Number three, they're planning for interest rates and the price of things to go down. So my thing is, why buy something and pay extra interest to be able to purchase something that you can't afford yet, just knowing that it's about to go down in price and knowing that interest rates are about to go down. So I mean, but purchasing something on a loan right now seems to be a bad idea. And really, even if you got the cash to buy it straight up, is probably still a bad idea right now. I would just say wait until the market begins to soften up, because Jerome is basically telling everybody that's coming. So I would just wait on that to purchase. Either way, really.
Yeah, I say the next 2 to 3 years will probably be the best time to get in there and start making them kind of moves. But right now, like I said, you gotta keep that capital on hand, man. Keep that equity on hand, man. Keep that capital on hand. Get ready to snipe whenever you see some opportunities.
Right now, do you rather have? I'm gonna ask you two questions. Right now, how do you think the high interest rate environment moving forward is going to affect Bitcoin?
How do I think it's going to affect Bitcoin? I mean, well, the price spiked and then it went back down. So me personally, it depends on the person. So like I'm a long-term investor. Like I believe fully 100% in crypto and everything about it. So price don't matter to me, but I do have a certain time frame where I'm going to be making, I'm going to be executing some real big moves. And I mean, there's been high volatility with these FOMC meetings. Like I like to trade also. I don't trade. Go ahead.
Let's say all the stuff, the interest rates, all the stuff Jerome talk about, end up bringing pain to the market. We end up having a disaster for like a year. A bad recession for like a year.
Mm-hmm.
Do you think it would be, if I'm going to invest in crypto, or if anybody was to invest in crypto, do you think it'd be a better idea to invest in it now, or to just stack cash and wait for another bottom?
I would DCA to catch some. I would DCA to catch some of them. Catch some of those bottoms.
DCA. What is
dollar cost average. So what I would do is, let's see. I have in my portfolio right now, I'm holding 8 coins. We're going to get into those 8 coins. I may up that to 10. We'll see. But for the 8 coins that I'm in right now, these are coins that I'm actually using. So I would dollar cost $10 into each of them every single week. So every month, well, not every Monday, I say Friday. Every Friday a dollar costs 10. So that's 10. It's $80 a week. So with prices coming down, with prices dropping drastically, I would
And
dollar cost average me personally into the 8 coins that I'm in right now. But for the audience, if I were you, shit, man, I do 10, 20, how much you can do, but I would dollar cost average. I wouldn't drop. So say if you, I don't know, say if you have like $500 and I'm like, okay, I want to invest this whole $500. I wouldn't just drop it all in there. I've made that mistake before. I've made that mistake plenty of times. Like as
gotcha,
soon as
bro.
I put that
I think
500
really,
in,
I don't want to go too far in depth into
uh,
the exact which crypto we'll be picking up while we're doing the FOMC meeting reaction. But I do think we need to put out a video, probably one of our weekly rundowns, going through those coins specifically, the top coins that you do have in your account, or either think that people should know about.
and then like we said earlier, none of this is financial advice. And I'm not telling you to invest in these coins. However, I want y'all to know what I'm holding. So I do want to be
That's,
transparent. I do want to be transparent
and
with that.
and I think that amount that you said, you said $80. I think when we talked last time, we talked about doing setting up either account or a paper trading account where we do and where we invest about $100 a week, what the average person would be able to invest, just so people can kind of keep up with it and see what the moves that we would make with that amount of money. Like I said, not as financial advice or anything like that, but just to have some type of template or
Yeah.
idea of how things work by watching us.
Yeah.
Yeah.
And to be honest with you, Alex, if with these interest rate hikes still going up, instead of doing the $10 in those 8 coins, I may do, because you'd be surprised, but I'd hold like rarely any Bitcoin. So one of my biggest holdings is Ethereum. So Ethereum is my Bitcoin, if that makes sense. So I treat Ethereum like Bitcoin. So another thing I would do would be I would split it. So I would split 40 into Ethereum. And you're gonna be happy about this. I will put the other 40 in Pax G.
Hey,
I'll put in Pax G. Like I would. Hey,
right now I
I
could
I,
see
I
right
buy
now
some
I could
gold,
see
man.
a 50% split in gold back stuff based off
I
the
buy.
way it's still going. But like I said, I
I
think we
buy
need to
some.
get all that in probably some of our rundown videos. But I do want to go
Yeah.
ahead and get back on task with Jerome's question. So let me go ahead and hit play on the video, bro.
Mr. Chairman, thank you. I think a couple times in your opening remarks talked about this language and determining the extent of additional policy firming may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings in September and November are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting. And as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path as it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week.
What you said?
So the Dixie, go back to that chart, the DXY chart. That's an important chart.
meeting.
When I'm trading, this is one of the charts that I look at every single time I make a trade. This Dixie, there's a correlation. So whenever the Dixie goes down, Bitcoin goes up. Dixie is the dollar. Bitcoin is a dollar index. So that's another indicator, trading indicator that I use. Like I don't look at it. I don't look at the chart. It's going down. I just do a long on Bitcoin. But this is one of the indicators that I use. Looking at this dollar index spot, the Dixie chart. This is an important chart right here.
And that can be used for stocks too. You right, it is
stocks too. Stocks too.
Yep.
Stocks too. So if the Dixie is going down, more than likely stocks, Bitcoin is going up. If the Dixie is going up, it means the dollar strength is going up. That means that Bitcoin mini stocks are going to go down. So I wish they showed the date. But yeah, I rolled this chart.
All this from today. That's
man. Oh, this is all today.
Mm-hmm.
Oh man, yeah. Oh man, look at that. Golly, jeez. So yeah, this Dixie chart is important. So if I'm trading, I always have this chart up. This DXY chart. I always look at this chart every single time, just to make extra, a little bit extra validation on what it is. Whatever move if I'm shorting or if I'm longing. But I make sure I take a look at this chart before I make any move.
Gotcha. I feel that if the Dixie go down a lot, definitely be buying stocks or crypto. If you see it going up, you might want to watch out.
Oh yeah. Take some
we'll
profits.
Also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to
be on the lookout for that right there. He said it's possible, and that's what I was expecting. Another rate before the end of the year. Probably that September, that November meeting. That's probably gonna be based off the data.
So when you think they're gonna pause the next one?
Yeah, I think I think they're gonna raise the rates. I think they're gonna do another 0.25% hike, probably either in September or November, depending on what the data end up looking like as far as job reports and all that stuff, CPI data, all that good stuff. I think they'll probably end up taking it up.
But just imagine if they wait. Just imagine if they waited till like November. Say they pause it. Say they pause in September. They don't do it in September, and then they decide to raise it another 0.25 in November. Man, these markets are going to be roaring up until like the beginning of November. So like roaring. It's profit taking time, baby.
Our markets now, I can see that for the crypto market. But if that was to happen at that moment, I don't think the stock market would be roaring, because it'd be easier. I wouldn't say easy. It'd be safer to place your money on bonds or in a CD versus buying stocks. So I can see a bunch of people jumping out of stocks for that reason. Plus, he just said that they're gonna start selling securities. So the stock market, I don't think gonna be roaring. The housing market, I don't think it's gonna be roaring, because the interest rate is gonna be so high on loans that the monthly rate is going to be unaffordable for a lot of people. So I can see the crypto market and potentially Bitcoin market.
Bitcoin supers. Yeah, because we got, say if that plays out, like I said, say they pause it in September, say they do another interest rate in November. Even if they do that, even if they do another interest rate in November, I still think the markets are going to roar, man, because that's November, December, January, February, March. That's 4 more months until the Bitcoin happening. And we know what, buy the rumor, sell the news. Is that what it is? So we're not going to wait. We're not going to wait until March when the Bitcoin halving happens to start. Oh, I need to hurry and buy me some Bitcoin before the halving. Like look here, man.
I think the halving
about 40
is less important than the actual what's going on with interest rates, though.
No, I don't know, man. I don't know about this. I don't know. We're gonna see. But it's 4 months before the halving, man, and I don't know, man. We'll see. I think we can maybe see a 40 or 50K before the end of this year.
I can definitely
we can probably see a 40. Yeah.
I can see it being possible. Like I said, especially if the market start tanking, I can see a bunch of people taking their money out of stocks, and I can see people assuming that crypto would be a quicker flip. I can see it, especially based off the past 2-3 years. So I can see it happening. I can definitely see it.
I'm telling you, man. Don't underestimate this Bitcoin happening, man. Do not. This is the most important, probably the most important thing to ever happen, like within these 4-year cycles with Bitcoin.
Yeah, this is a normal 4-year cycle, but like I said, I can see interest rates being high and held up being more important than that happening, because you're gonna have money moving out of different sectors of the economy versus the same investors. That's all I'm saying.
Say that again.
You're gonna have money moving out of different sectors of the economy versus the same normal crypto investors jumping in and out.
I think some of that money gonna flow into Bitcoin, man. Bitcoin specific.
Yeah, that's what I just said. You're gonna see some money coming out of other sectors into cryptos. Bitcoin is a crypto.
Yeah. Oh yeah. All right, let's see what you got for us, Jerome.
We're going to be making careful assessments, as I said, meeting by meeting.
But look at that. Jesus.
Well,
look
at
the
S&P. 525 basis points since March.
He said they're going to hike again, bro.
He
said himself that they're going to hike again more than likely. So that's a reason for the markets to go up.
Something you said there. You said the data in the intermediate period, it probably came in.
It's still going up.
Is that there's unlikely to be a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
But once he definitely said they're going to stop going up, bro, watch how the market.
That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all that and making that assessment then. And it really,
I feel like they're really pissing him off when they keep raising his
we've seen this before in the data. We just don't know that until we see the data.
He's like, okay, y'all want to keep doing that?
But he turned it red. He turned it red.
Obviously, you upgraded the language around growth in the statement today. We've seen Barbie movie numbers. We've seen concerts this summer. It seems like the American consumer is in pretty good shape, and it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing but doing, performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way: the overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy overall, that's a good thing. It's good to see that. Of course, it's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looking good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal.
So the guy asked him if interest rates are starting to go down and everything is working, why did y'all still go up another quarter basis point? And Jerome basically just said we did it because of the jobs market. He straight up just said it.
I mean, they need folks to lose their jobs, bro. People need to lose their jobs in order
growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter. And that by September, that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of
He
this
just
and how much of
answered his
that.
own
We'll
question.
be looking at everything. And, of course, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data, and that's what we're going to look at. We're going to make that decision then, and that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal, whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber, Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, well, your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not. But as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But, we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headlines are going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task. And we think we're going to need to certainly hold policy at restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So
that is a good question.
How much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater. And that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity. And that's the thing we really need to avoid and will avoid.
He didn't answer the question, bro.
But they're not supposed to answer the questions.
Yeah, but still,
they ain't supposed to answer these questions, man. Look, Jerome looking at his phone right now. Somebody to text. Somebody to text that. Somebody to text it. Be like,
yeah, you better not answer that question.
You better not answer that goddamn question.
The question was how many jobs need to be lost. He basically said it's more important that we stop inflation. His answer to the question was it's more important to stop inflation, and to lose jobs would just be a short-term basically trade-off for that. You know what I'm saying? He didn't answer the question at all, bro. Like,
nah, man. But I mean, hey, apparently a lot of people need to lose their jobs for it to happen, man.
Yeah, bro. I wish he would have gave a definite answer, but I get what he's saying. He not directly trying to take jobs, just the stuff that he's gonna be doing.
Bro, I feel you. I don't get what he's saying. He ain't answer that question, bro. He looking at his phone right now. somebody texting Jerome right now saying you are you better not. Who texted?
Hey, and you say that they're gonna block the video.
I ain't gonna say it. I don't want to get us banned. I don't want to get us. This is our second video. I don't want to get our second video banned.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating? And you're able to go back to the old Fed policy of opportunistic disinflation.
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. And what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month and explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible. I mentioned before, it's possible that we would move it consecutive. It means we're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. So among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy. And there are those who feel, they say it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process. from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags plural that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation repeatedly has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data. And given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side.
Hey, bro, it's getting a little repetitive to me. How about you?
What'd you say?
Getting a little repetitive.
Yeah, man. They not asking no good questions.
Yeah, I mean, yeah, everything has pretty much been said. But before we go, I did want to check some stuff out and show the viewers, and you might want to do the same thing before we go.
What's that?
Let me see if I can pull up this screen right quick. Give me just a second.
Bro, I got this hoodie, man. I got this Bitcoin hoodie. It's like a meme coin, bro. Like, hold on, man. Hold on 1 second. You got to see this. Hold on 1 second. Hold on 1 second. Hold on 1 second. I want you to see this. All right, man. All right. I want you to see this. Tell me. I want you to tell me this shit ain't fire than a motherfucker, boy.
Remind me to go back to that chart when you get done.
Well, look at this right here, my boy. Boy, look at it, boy. Look, you got Doge on there. You got ApeCoin. You got Uniswap. You got Shiba. Sandbox. Bro, tell me this thing ain't all this shit harder than a motherfucker.
I need to find me one with like.
I love it. I love it. Well, I love it, man. Look at this right here. Look at this right here. Look at this. I'm gonna be wearing this when I come up out the Lambo.
Hey, bro, what I wanted to show you though, bro.
Go ahead. Let's see.
They started rate hikes in March of 2022, right? You see
March
this ring?
March, yeah, I can see it. March 2022.
March of 22, which is right here.
Mm-hmm.
When they started them rate hikes, right before they start speaking on it, when they start speaking on it right up in here, the market started to crash once they started talking about doing it. And the markets went down. This is the S&P 500, bro. But right now, today, the market is less than 5%. The S&P 500 is less than 5% away from its all-time high.
Yeah.
So my thing is, they didn't did all these rate hikes and stuff,
and we right back up there.
Stock market, it ain't did nothing. Like it's probably gonna hit the housing market real bad soon. It's gonna hit jobs if it end up hitting the stock market hard enough. But as of right now, they're just gonna force bank failures first, and because in my eyes, this right here, it has to go back down. As of right now, it's basically technically no effect on interest rates on the stock market at all.
Man. Not at all, bro. Like I said, man, I be going. I got a conspiracy theory mind, man, and you know, if you look at this chart, bro, like it's like all of the stuff that all these interest rate hikes they've been doing ain't been doing jack shit. Nothing. Look at, bro, we damn near all-time highs right now, man. So I'm like,
that's another reason they're gonna have to hold them rates high.
Yeah, man. Because I'm, bro, man, that chart look bullish AF.
But all the charts look like that for S&P, NASDAQ, the Russell, everything looking like that.
Yeah, you see what Facebook did, bro. Look at pull up that Facebook chart. that meta chart, boy. Hey, man, I gave up on Facebook, man. Y'all think you got me on that Facebook. Remember I told you I don't think Facebook gonna come back.
I told you.
But you got jeez, look at that.
It was like at 100, wasn't it? It was almost at $100.
Oh, look at
that. It went to $100. It didn't triple.
That's bro, $90. That's $90. That's $10 less than 100.
Look at my point. This is 2022. So this was before they started announcing that they was gonna do rate hikes. It went down, but it pretty much bounced back, bro. It's $30 off, so that's like 10%. It's 10% off his all-time high.
That's crazy. Let
me see what Google is.
Bro, that's insane. Let's see fire on Google. Let's see what Google looking like. Google. Damn.
It's right off his all-time high, bro.
Go to NVIDIA. Go to NVIDIA. See what NVIDIA look like.
It's probably at its all-time high.
I want to get some NVIDIA stock so bad, man. But look at this. I'm gonna show y'all the reason why I'm not buying it. This is the reason why I'm not buying it.
I wish I can find that paper that I wrote to you, those stocks I was talking about getting.
That is why.
Look, bro.
That is why I'm not touching NVIDIA, even though I want some NVIDIA so bad.
And what's NVIDIA's biggest thing? 5G. How much has 5G changed, bro? Like I might be missing out on something, but how much has 5G changed, bro?
Look at that. Look at that. But but my thing is this though. So this is my question though. If you look at NVIDIA, I mean, bro, didn't NVIDIA hit $1 trillion market cap? It did. NVIDIA hit $1 trillion market cap, man.
It was probably half a trillion not long ago.
Jeez. Then we got gold at 1,988.
Trying to hit the 5.
Yeah, go that 5 year. Let's see what that 5 year looking like.
It's basically the same spot it was in. It ain't been no change.
Pretty much.
It hasn't been a change, bro.
Pretty much.
What's crypto? What's Bitcoin looking like?
Pretty much.
Bitcoin kind of different, but let's see.
Pretty much. Go to Britcoin. That's Britcoin. I don't know what Britcoin is. Look,
I'm
it's a Britcoin.
I guess it's a British kind of type situation.
29,470.
Oh, I see. Now Bitcoin.
Look, y'all look at that. Y'all see, look, that's $61,539.30.
It looks like the only thing that's been affected by rate hikes is Bitcoin.
Yeah, and look at that, bro. I rolled that thing.
It was at about 43. It was at about 43, 45.
But look, this is why I'm officially a crypto OG. I rolled that thing all the way from the top down. But guess what? Hey, keep going now. That's I was buying right there. I was I was feasting in that area right there. I was feasting, and I was telling everybody, I was like, hey, not just Bitcoin, man, but all right, I want you to look at 3 other charts. XRP. Let's look at XRP. We gotta look at XRP.
XRP different. XRP different because they've been getting affected by that
from that lawsuit.
Lawsuit.
Yeah. but y'all be on the lookout for an XRP video. So let's see, even XRP.
No. I'm going the wrong way. I'm tripping.
Even XRP. So all right, keep going. Look,
XRP is technically down since they started doing rate hikes.
Yep. So I started buying XRP right there. Right there. I bought a little bit at 83 cents, but majority of it was right up in this area right there. That
so you did just get in there and
right up in there. So then
so much time left in this video. Cause we had 50. I don't want to go. Smart market. We didn't check cryptos. I checked metals. I checked gold. That's pretty much the main metal.
Let's see what else. Hey, go to ETH. Go to ETH. Let's look at ETH. Let's see ETH. Let's see how ETH looked. 1880 75. 1880 75. My claim to fame was I bought me one ETH. I bought an ETH at $600, man. I bought an ETH right up around that point. Right up around that point was where I bought my first whole ETH at $600. Rolled that thing all the way up there by.
So really, brother, it's looking like the only thing that really been hit hard as of right now, like I said, I think housing gonna get hit soon, but the only thing that's really been hit right now is crypto, and I don't think that necessarily got to do with the interest rates and all
the interest
that.
Rate, yeah.
I think they got to do more so with certain big whales and stuff, just pulling out and kind of doing a money grab while everything was at its all-time high.
Yeah. Yep.
And I could be wrong, but you know. So you got anything else you want to talk about, bro, before we go ahead and wrap it up?
Shoot, man. Hey, man, I appreciate everybody tuning in. Like I said, this ain't no financial advice. However, we want to share our opinions with you guys, especially those who are trying to get into the markets, who's trying to, make some money, preserve your capital.
And I'm finna make an announcement. I ain't even ran it cross markets yet. Marcus,
I don't know. I like surprises, man.
If you disagree with me, bro, we can chop it up, figure out how we need to do it. I'm hoping you can do the same thing. Like I mentioned earlier, eventually we're gonna have it where we invest in using paper trading. Do you personally have an app that you use for that? You ain't got to mention the app, but do you have an app?
I have an app, but it's a crypto app.
That's what I'm talking about, crypto app.
Yeah.
Okay, so that goes along perfect what I'm about to do.
Yeah.
I think what I'm gonna start doing in the bottom of the comments of the video, whatever app you use, your link to that app, you might need to put that down there. I'm gonna put my link to Webull. And if you plan on paper trading stocks, y'all can download the Webull app. If you sign up, it'll help us out. It'll personally help me get free stocks for joining Webull. You would get free stocks for joining Webull. And Marcus, what is the app that you're going to be using for paper trading?
I use for Bitcoin. I use BitGet. BIT.
Now, bro, you ain't got to spell out. We're gonna put it all in. We're gonna put it all down in the description. If people are to sign up using your link, would they get anything?
You probably won't, because I'm using it without KYC, and that's why I like to use it, because you don't have to do the KYC, which is know your customer, which is basically, you have to log in, you have to put all your information on there, all of the stuff like that, which, I'm kind of big on privacy, and that's the reason why I love BitGet, is because they don't force you to do all of that stuff. It's an option for you to do, but it's an option to do. So we'll see. I may go ahead and do the KYC so I can get, I can start giving out that referral link. But as time goes on, y'all know, I'm huge on this privacy thing, man, and not giving out a lot of information, so that's one of the main reasons why I use BitGet, is because they don't force you to KYC. Like there are a few other apps that I love, like like KuCoin. I still love KuCoin, but I woke up one morning, bro, and they was like, "You got the KYC." I was like, "What?"
All right, so like I said, I'm gonna put the XRP link down in the description. I do know that you can paper trade cryptocurrencies. Did I say XRP?
Yeah, you did. Yeah, you did.
I'm gonna put the. I probably been saying XRP this whole time. I might have been tripping, but I'm gonna put the Webull link down in the description. If you download,
I mean, it's straight, man. You know, that's the chosen one. This the chosen.
Hold on, bro. You can indeed paper trade. You can indeed paper trade cryptos. I don't know if it include all the cryptos that are on the app that you just mentioned. But do you have a Webull account, Marcus?
I do have a Webull account. I just haven't used it, man. I'm 100% in crypto.
So what we might need to do, like I said, you can broadcast, saying via whatever you want to. But if y'all want to support Marcus, you know what I'm saying, download the Webull link that's gonna be beside his name, and you know what I'm saying, you'll get your free stocks or your free crypto for signing up, and it'll also help support us. And if you want to do the one beside my name, you'll still get your free stocks or your free crypto, and it'll help support us. So it's completely up to you guys. If Marcus end up doing another link, we're gonna always have that down there for you guys. But I do want to have something in the video that you guys are tools for you to use and a way opportunity for you guys to come up and somehow. That was a super long conclusion. I appreciate y'all for staying here, watch the video. As always, I'm gonna let Marcus give y'all that disclaimer one more time because we are not advisors, and I'm gonna be out myself.
Hell no, man. We is not financial advisors. We are not financially. Maybe one day. Real talk, man. Maybe, for real though, we may not be saying this for long, man.
Real talk though, bro.
We may actually be some financial advisors soon, man. So
we may be. We'll have to have a lot of time on our hands for that though, because you got to get your license and all that stuff. Go back to school and all that stuff.
Yeah.
So if I'm rolling in the cash and I ain't got nothing else to do, maybe I go back to school. But
maybe.
Until then, I'm gonna keep pointing at you and be like, "What's the disclaimer, bro?"
This is not.
And even if I became a financial advisor, I wouldn't be advising directly through the YouTube. You'd probably have to contact me personally or something.
Yeah,
we're not financial advisors on this channel.
Exactly. We don't want to get a call from Gary. We don't want to get a call from Gary.
Y'all have a good one though. Make sure y'all subscribe. Make sure y'all check out the weekly rundown every Sunday. And we're gonna be having videos pushing through every week for y'all every other day. Make sure you watching the channel. We out.
See you at Carnival.